Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi everyone, welcome to this podcast on India Fixed Income. This is Shaily Gang, Chief Investment Strategist at Standard Chartered Bank, India. We will be discussing FY27 outlook on liquidity, bond demand supply dynamics and yield movements in the background of RBI's recent measures, including FCNRB deposits, ECBs, etc., and a recap of the scenario in FY26. First up, let's understand how the fixed income canvas panned out in FY26. RBI stayed dovish for most of FY26, 125 bips of repo rate cuts, INR 8.8 trillion of OMO purchases, 100 bips CRR cut. But forward guidance turned hawkish as the stance shifted from accommodative to neutral in June 2025. This impeded transmission of lower rates as bond yields rose 75 to 100 bips across the curve, with the curve flattening by March 2026. Talking of liquidity, it remained tight in FY26. RBI sold dollars to support the rupee, draining liquidity that had to be replaced via OMO purchases. Forex intervention and currency leakage kept liquidity low and short-end yields under upward pressure. Regarding bond demand supply, it was adverse in FY26. Credit growth outpaced deposits, driving high CD issuance and pulling out money out of liquid funds, which is weaker MF demand for short papers. Banks favored loans over government securities, and the SLR demand for government securities was already saturated. Plus, pension demand fell on benchmark changes. The West Asia conflict then accelerated FPI outflows, making April-May 2026 amongst the weakest months on record. FY26 saw rising yields among corporate funding sources. Offshore borrowing and domestic bonds both turned expensive with high hedging costs, tight liquidity and rate hike expectations, while benchmark-linked bank loans stayed cheapest. This pushed bank credit growth to 16 to 17% year-on-year in April-May 2026. Funded via CD issuance, that is of over INR 6 trillion outstanding, with CD spreads widening beyond prior stress episodes and pushed up yields. Come FY27, yields have been volatile through the year but trended down, with the 10-year GSEC falling to a multi-week low in June 2026. This was with RBI announcing steps to attract capital flows in its June meeting, ceasefire announcement by US and Federal Open Market Committee decision to hold rates while sounding more hawkish. FY27 is expected to be a year of improving liquidity, better bond demand supply dynamics and easing yields as the impact of RBI's capital inflow measures pan out. Yield on 10-year GSEC ended the month with decline of 25 bips, while that on 10-year AAA corporate bonds witnessed a sharper fall, resulting in the spread between the two compressing by about 20 to 22 bips. Talking about liquidity in FY27, it is expected to improve. FCNRB deposit scheme with hedging cost borne by RBI has the potential to attract USD 40 to 60 billion. India drew USD 34 billion under a similar route in 2013. FCNRB flows don't create SLR demand. Now, what is SLR demand? SLR is a banking regulation requiring commercial banks to maintain a minimum percentage of their deposits in the form of specified liquid assets before utilizing them to offer credit to customers. SLR demand refers to demand for government securities created by this requirement. Thus, FCNR flows do not create SLR demand. However, the banking system receives significant rupee liquidity as the FCNRB deposits are swapped with RBI, expanding the durable liquidity base over the quarter. this is a net new dollar inflow into the system. Core liquidity is expected to rise sharply, with banking system liquidity expected to increase to about INR 5 to 6 trillion. Just to give a reference number, average net liquidity surplus was rupees 1.6 trillion in May 2026 compared to rupees 3.8 trillion in April 2026, driven by RBI's intervention in forex markets and rise in currency in circulation. RBI has been selling dollars in the forward market rather than the spot market to smoothen volatile rupee, building a large net forward dollar position, but without immediately running down spot forex reserves. Selling dollars in the spot market immediately reduces liquidity. RBI's net short forward book has already ballooned to $106 billion in May 2026. With fresh FCNR flows, RBI's forward book pressure eases in the near term, but in the medium to long term, a new forward dollar sale obligation gets created, dated 3 to 5 years out at a locked exchange rate. FCNR-B reprofiles RBI's total future dollar sales commitments. It buys time. The FCNR flows partly offset the drain in core liquidity from the maturing forward book, cushioning liquidity. Any sterilization of liquidity by RBI is likely to be back-ended with OMO sales in the last and least preferred option. It's not a near-term concern. Now on the bond demand-supply front, better dynamics are expected in FY27. Under this, first on the measure of concessional forex swap for PSU ECBs, external commercial borrowings, that is ECBs. It makes offshore borrowing competitive versus domestic bonds, reducing domestic corporate bond supply while also easing credit demand from the banking system, particularly for large PSUs or oil marketing companies facing working capital pressure from the incomplete pass-through of crude prices. Potential to attract USD 15 to 25 billion. FCNR-B inflows alongside not requiring CRR or SLR can substitute deposit raises via CDs and bulk deposits and meaningfully reduce bank CD issuance, tightening spreads over treasury bills. Next on FAR GSEC universe expansion, 15-year, 30-year, 40-year government security issuances with FPI short-term limits removed. Now this measure improves FPI access and demand for FAR tagged securities, supports Bloomberg index inclusion, that is about approximately 0.7% weight to the tune of USD 25 billion. Of course, this is subject to global rates or interest rate differential and risk appetite. Capital gains or withdrawal or withholding tax removed on GSECs has the potential of attracting about USD 10 to 20 billion over the next 12 to 18 months. This brings India on par with emerging market peers, aiding future index inclusion. Now, what is the net effect of all of these? Bond supply falls, while sovereign demand rises from both banks and foreign investors. This, together with the Middle East ceasefire, easing inflation and BOP concerns, has stabilized the INR and driven a significant easing in yields across the curve. And FPI debt flows and corporate bond issuance have also picked up and are picking up since early June. In summary, the scale and pace of capital flows has addressed several near-term problems at once. Stabilizing the INR by easing currency pressure, improving domestic liquidity, potentially taking interbank liquidity to about 5 to 6 trillion rupees by September 2026. Moderating the credit to deposit ratio via stronger deposit growth through FCNR-B deposits and lower PSU credit demand, that is through easier external commercial borrowing norms. Reducing CD supply as banks substitute FCNR deposits for wholesale funding and improving the balance of payments position overall. What is our outlook? With falling credit to deposit ratio, improving liquidity surplus and weak credit demand due to RBI's recent measures, short-term yields are expected to come down and corporate bond spreads are expected to compress. Long-end bond yields are expected to remain anchored given the steep sovereign curve. Fully accessible route inclusion, that is FAR inclusion of new 15, 30 and 40-year papers, and government borrowing shifting to lower maturities. Favorable risk rewards seen in long-end bonds and state development loans given the steep sovereign curve and attractive yields on offer. Thus, we recommend corporate bond funds, short-term bond funds, and money market funds basis our outlook. Thank you everyone for listening in and happy investing.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.